One of the most important variables to estimating the value of any stock is to estimate what the future growth rate of the business is going to be. If you're using a dividend discount model, then you use the estimated growth rate of dividends. And if you get that right, chances are you're going to get the valuation very close. If you get the growth rate way off, you're going to get the valuation way off. This has been a pretty crazy week for me. We've had some major issues with our house that I've had to take care of. Had several projects at work I had to get done, so I haven't been able to make a video. But I thought, I've got 51 videos that I've already made. I'll just borrow one of those and use those for this week's video. So that's what I did. This week's video is from my valuation course talking about, in the context of the dividend discount model, how do you estimate dividend growth rates? Even if you don't use the dividend discount model, one simple shortcut that you can use is simply take the dividend yield plus whatever the long-term estimated dividend growth rate is for a particular stock, and that will give you a general idea of how much you could expect to earn if 1, you were 100% correct, 2, the dividend continued to be paid as is, and 3, you held the stock indefinitely. So here are 5 ways that you can estimate the future dividend growth of a company.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
In this video, we're going to go over a couple ways to estimate the future dividend growth of a business. So there's several different ways to do this, starting with the most simple, which is to simply use the historical dividend growth rate. So here I am over back at quickfs.net. You can access this front page for free. So one of the things you could do very simply, like we did before, was just simply look at what the dividend growth rate has been historically and use that going forward. So you could calculate the compound annual growth rate over a 10-year period. So maybe take 236 and calculate the growth rate to 592. That would be one way to do it. You could also just simply take the average of these historical dividend growth rate numbers per year. You could look at the median number like we did. There's a lot of ways to do that, but historical dividend growth can be a good starting point for estimating future dividend growth rates. Another way to do it is look at historical earnings growth rates. Now, obviously, dividends come from somewhere. They have to come from earnings. So if earnings are growing at like 5% and dividends are growing at like 15%, well, eventually the dividends are going to have to slow to match the earnings growth. You can see this was definitely the case with 3M. Take a look here in 2015. If we look at the earnings per share growth column, earnings got pretty stagnant. So they grew at 1.2% and then 7.7%, and then they actually went down 2.8%. You can look a little further, and then next year, 2018, they went up 12.1%, but 2019 earnings dropped by 13.2%. So if you just take a look at 2015, earnings per share were $7.58. 2019, they were barely higher at $7.72. But if you look at dividends, dividends actually increased fairly dramatically over this period. So looking at dividend growth, 2015, earnings were up 1.2, the dividend was nearly 20%. 2016, dividend growth was 8.3 compared to 7.7 for earnings. Dividend growth again went up more than earnings. Dividends up 5.9, earnings down 2.8. Dividends increased 15.7 compared to 12.1 for earnings. And then again, a 5.9% increase in the dividend and a 13.2% drop in earnings. So the dividend is basically doing this, and the earnings are basically doing this. So eventually, this dividend growth is going to have to slow. That or earnings are going to have to increase. So it can be really useful to look at the growth rate in earnings. QuickFS actually calculates the 10-year growth number for earnings for you. So you can see for 3M, it's been 5.4%. You can also, again, take the median of these earnings growth numbers. You could calculate the compound annual growth rate like they've done here. But definitely paying attention to earnings is very important. Another thing to pay attention to is sales. If dividends come from earnings, earnings ultimately come from sales. Can't make earnings without making sales. So another thing to take a look at is sales, or also called revenue growth. And that on QuickFS is listed here. And you can do the same thing we've done with earnings and dividends, looking at either an average each year or just kind of taking the median of these numbers. But I think at least in 3M, the revenue growth is the most sobering and probably the most concerning that you would see. You can see the 10-year compound annual growth rate of sales has only been 1.8%. So while dividends have basically doubled over this time period, going from $2.36 to $5.92, the revenues have gone from $29,904 to $35,355, which, like they've calculated, is about a 2% revenue growth rate. So eventually, the earnings are going to have to slow to roughly match the revenue growth rate. And eventually, the dividends are going to have to slow to match the earnings growth rate. And finally, one way that you can kind of check yourself is to look at what the analysts are currently estimating for long-term earnings growth. And you can see that analysts expect that the next 5 years, 3M is going to grow its earnings at just 0.4% per year. And if you want to find this for yourself, you can simply go up here to Yahoo Finance and go up here and type in the ticker symbol that you're looking for. So 3M is what we were just looking at. It takes you to this page. You can click on Analysis and then scroll down all the way to the bottom, and you'll see growth estimates for next 5 years. And finally, the last thing that you can and probably should do is make your own projections. So this is just an example of something that I worked on for Disney. And what I did was went through each of their different major business segments and made my own estimate for operating profits. Obviously, this is going to require more extensive knowledge of the financial statements, but this, I think, is the way that you can most, I don't want to say accurately, because you may be less accurate than the other metrics we've talked about, but this is, I think, a way to understand the key drivers of a business is to kind of forecast the profitability for each segment. So if you're interested in kind of going through that in more detail of kind of how you would go about doing something like that, I'd be glad to make a video. Maybe that'll be kind of more of an advanced video for later on in the course. But anyways, I think that's another way, probably the best way that you can go about doing that. So that is the basics of how to value a stock using the dividend discount model. If there's anything that was not clear or you'd like to see more information on, please let me know. You can send me a direct message through the Experienceify platform. You can also send me an email at nathan@dividendgrowthmachine.com. So just let me know if you have any questions, and I'd love to answer them for you. I'm always going to be adding content to this course, so just let me know if there's any requests that you have. If you're interested in more valuation content, you can check out the description down below. Hopefully, I'll be able to make an original video this week, so I will see you in the next one.